we have Dave Foster, who is a 1031 exchange accommodator and expert in the space, based in Tampa. We're here to talk about 1031 exchanges and Delaware statutory trusts and how real estate investors can utilize both as a tax deferral strategy for their real estate investments. So Dave, I'll let you kick it off and start. Since 1031 exchanges are kind of the preemptive process to the Delaware Statutory Trust, why don't you start and tell us a little bit about what a 1031 exchange
Yeah,
is?
absolutely. And by the way, everybody that's joined, thanks so much for enduring our little back closet industry jargon session there. Um, it's kind of fun getting to cross-pollinate with professionals from different industries, particularly when we find the places where they can confluence and provide synergy with each other. And as Jennifer and I have been discovering with each other, the whole idea of the 1031 exchange and Delaware Statutory Trust is such a beautiful melding of a process that's going to help the real estate investor defer and avoid paying tax on real estate sales and use that money that they didn't pay to the government to purchase assets that are both less active intensive and at the same time providing cash flow simply off of the deferred tax. It's like instead of paying the government, you put the money into your own pocket and it starts paying you. But it all starts with the 1031 exchange. Like Jennifer said, the 1031 exchange has been around since 1920, and it allows real estate investors to sell investment real estate, do a process, and buy new investment real estate. And by following the process, they get to indefinitely defer paying tax on the profits that they normally would have. Now, the power of that, I just alluded to, is that you're taking the tax and making the money off of the tax, which then compounds because you then get to make the money off of the money that you saved from paying tax. And that's such a powerful concept. We're seeing probably more than 1 million 1031 exchanges are being done every year by real estate investors to harness that power. But 1031 exchanges come with a price. They require you to stay invested in real estate. And there's some things that can make that less advantageous for people. For instance, I've had a great run as a real estate investor, but I'm now tired. I don't want to invest in real estate anymore. Well, I could sell my real estate and I could pay the taxes, and then I could go buy stocks and bonds and equities and even shares of REITs and those kinds of things. But that's all going to start with me paying the tax. And it's a lot of tax I don't want to pay. Or my lifestyle changes. I was into vacation rentals because I loved to vacation and stay. But now that's not so much a priority to me, and I can make more money in the stock market or somewhere else. But if I sell, I've got to pay tax. Now, that's the general principle of the 1031. And the way that it fits with the Delaware Statutory Trust is that in 2004, the IRS officially encoded legislation that declared that DSTs are real estate. Poof, voila. Now, Jennifer, as you and I know, the Delaware Statutory Trust is just a trust that happens to have been formed in Delaware for the purpose of owning a piece of real estate. Now, with the 1031 exchange, typically you cannot exchange into a membership interest in an entity that owns real estate. That won't count. So you'd end up having to pay the tax. But the Delaware Statutory Trust is what allows you to do that and keep the tax deferred. So it's the one financial product out there where you can go absolutely passive into an equities-like situation and yet have it count for 1031. So that's pretty powerful right there. The other things that we're seeing from our clients, and I'm sure it's echoing with yours as well, is that in a 1031 exchange, the timelines are very limited. You only have 45 days to identify your potential replacement properties and 180 days to close on them. In today's market, that may not be enough time. At any point in a market, something's going to be more difficult. Maybe it's more difficult to sell your property, or maybe we're in a part of the real estate cycle where it's more difficult to find the property you want to buy. In either of those cases, that 45 days is going to feel awfully confining. And the Delaware Statutory Trust, because of its nature, that I'll let you talk about it a little bit, allows you to mitigate that 45-day angst. So we will have investors using these as backups, or even just saying, Dave, I don't know that I'll be able to finish my 1031. Is there any other option? And I say, yeah, call Jennifer.
Right, right.
Those are
So
really
yeah,
the
that
two major things.
right. And that's an excellent intro into Delaware statutory trust. So to go delve a little deeper into that, DSTs, typically the IRS looks at them as a like kind investment. So when you're selling your investment property and you're trying to defer capital gains through a 1031 exchange, the IRS has a very wide definition of what a like kind property is. You can sell your multifamily property and exchange into really any kind of like kind property. That can be a self-storage property. It can be medical office, student housing. It could be air rights, mineral rights. The IRS also allows you to invest in what's called a Delaware statutory trust. What exactly is a DST? Well, first of all, and let me introduce myself. I'm a registered broker. My name's Jennifer Sotelo. I'm with DST 1031 Investments, and I specialize in DSTs. So a DST essentially, when you're taking your investment property and you're doing a 1031 exchange into a DST, you are buying a fraction of an institutional grade property, and you're investing with a group of other investors. So you have beneficial ownership of that fraction of that institutional property. Okay, what types of properties are DSTs? Think any sort of Class A multifamily 300 unit apartment building. Amazon distribution centers. I've seen Ford distribution centers, FedEx centers. There's at any time can be about 90 different DSTs on the market. Some of them only have one physical institutional property. I've seen triple nets that have a small portfolio within one DST. So there's, a multitude of options for investors to choose from. Going back to what Dave said, with a 1031 exchange, you're limited. The IRS gives you 45 days to identify a property and 180 days to close on that property. With a Delaware statutory trust, why investors like DSTs is because when you are investing in a DST, everything is already in place. The investment firm, called the sponsor, who manages the property, already they've done the due diligence on the property. The property is purchased. If there's any financing on the property, all of that is in place. Management team who's going to manage the property for you is also in place. So everything's in place. So typically, I mean, we can get investors in a DST immediately, which really eases that concern with that 45-day deadline. Going back to also what Dave said, let's say, you are in your 45-day exchange period and you want to invest in a physical like kind property. Okay, well, there's a lot of things that can possibly go wrong during that process. The seller can back out. You may not be able to get financing. So you can use a DST as a backup um, it- to that physical like kind property. So if you aren't able to identify that property within or close on that property in 180 days, you always have that DST as a backup, which is great. So Delaware statutory trusts, they're a completely passive investment. So, going back to what Dave said, if you're tired of managing your own property, you no longer want to deal with the tenants and toilets and all those other terrible T's, as they call them. You can invest in a Delaware statutory trust, continue to defer that capital gains through the DST and have the sponsor manage the property for you. You receive all the benefits of owning real estate. So typically, there are some exceptions, but you're receiving a monthly distribution from that DST. Um, you also, if there are any sort of tax benefits, you receive those as well. And then each GST, I get this question a lot. So it's an illiquid investment. So once you're in it, your shares are in it for the duration of the investment, which is typically 5 to 7 years. So at the end of the 5 to 7 years, the sponsor will sell the property and the investors receive their proceeds back, as well as any appreciation that's accrued during the time that they've held the property. So you receive all the benefits of investing in real estate, which is great. The other benefit is that you really get you can diversify over multiple asset classes and over multiple sponsors, which is what I like to do, right? We all try to diversify our investments. So meaning that you can, let's say you had $1 million, you could put $200,000 into a multifamily property, $200,000 into a self-storage facility, $200,000 into a medical office building, and have exposure over those different asset classes. So there's a lot of different creative ways that you can use a DST. There's also a lot of different types of DSTs too. So you have the traditional DST, which is what I'm referring to. You also have what's called a 721 UPREIT, which can be really interesting too. In that scenario, the investor is in a Delaware statutory trust for 2 to 3 years. And then, just to simplify everything, that that DST transitions into a REIT. So there are a lot of benefits into for that. We can always go into that deeper. We have limited time here. And then there's also cash out refi DSTs, which are really interesting too. So you can invest in the DST and essentially do a cash out refi like you would any other property. So there's a lot of different ways, not only a lot of different DSTs, but a lot of different types of DSTs that individuals can invest in. So just understanding what your options are, and knowing that these opportunities are out there for you can really, I think, help a lot of individuals who maybe feel like, they're scared to sell their property because they're scared of paying the capital gains tax, or they're scared of the 1031 exchange deadline and not being able to find another property. DSTs can really alleviate some of that stress. So I'm going to pause. Dave, is there anything else I should cover, or do you think there are any questions?
Yeah, just to piggyback on one thing you just said that so powerful, the cash out refinance, DST, absolutely mitigates any risk you've got of finding the right property because you're going into the DST, you're generating cash flow, and then you cash out the refinance whenever it's appropriate during that period. Now you've got a non-taxable event and cash in your pocket to go find the piece of brick and mortar if you're wanting to also buy regular real estate. So our clients love those. I'm glad you brought that up.
Yeah, yeah. And so there are some tax implications, and we, would have to discuss all of that in detail further. But yeah, it can be a fantastic tool for certain individuals, which is really interesting, and which, I think makes what I do really interesting too, trying to understand the client's needs and um, trying to figure out a solution to all of their needs. Trying to think, of other specifics about DSTs. I mean, that's pretty much the 30,000 foot overview of what a DST is. Some of the people who might find Delaware statutory trusts helpful for them is, it can be, we talked about the individual who no longer wants to deal with the terrible tease of being a landlord. They don't want the responsibility. Somebody who's looking for a backup property just in case their first option falls through. Um, and it can really be somebody who's ready to retire from real estate, but they still want to continue to defer the capital gains. So you want to, and so you want to continue to defer the capital gains, maybe pass it on to your heirs. DSTs are an excellent succession planning tool for a number of reasons. One, your heirs receive a step up in basis with DSTs. So meaning that when you pass the DST to your heirs, the capital gains that you've accrued during the time that you held the property are eliminated when it's passed on to your heirs. And I always say I'm not a CPA, check with your CPA. But traditionally, that's one advantage. Another advantage is each individual heir receives their pro rata share. So there's no arguing. You know that the investment is going to sell in 5 to 7 years. That's included in the private placement memorandum by the sponsor, which is the legal document that outlines every aspect of the DST. Um, and so that the investment is going to sell in 5 to 7 years. So there's no, the heirs aren't squabbling about whether or not to sell the property. Do we, don't we? It sells in 5 to 7 years, and each of the individual heirs gets to do what they want with their share of the investment. So there's a lot of I think benefits to DSTs.
Another class of client that we're seeing more and more of every day are those who are high performing W-2 wage earners or entrepreneurs of sorts or the white coat professionals in the medical field who have significant income coming in from highly taxable sources. And they will buy, there is a unique part of real estate taxation that allows vacation rentals to be taxed as active investing as opposed to passive investing within certain criteria, so that a practicing doctor could buy a vacation rental and, again, within certain parameters, be able to write off additional depreciation on that property while they're owning it and managing it. So that has the benefit of lowering the taxes on their regular income. The problem is that depreciation comes with a price. It's the gift that the IRS takes back when you sell it. And it's very common for someone to say, buy a $500,000 piece of property, take the depreciation down to $200,000 of basis. Well, even if they sell the property the next day for $500,000 and think they're not making a penny, that's a $300,000 gain that the IRS is going to take back at regular income rates. So, because the 1031 exchange allows you to defer not only the capital gains, but also depreciation recapture.
Yeah.
That's a huge market. I don't want to own real estate anymore. I'm tired of vacation rentals, but I'm going to pay a lot of tax if I sell. Why not put it into something that's producing monthly income? And we're seeing that quite a bit now.
Yeah. Yeah. I mean, that's a great point. It's you can um do a 1031 exchange with pretty much any investment property. And so I do hear that a lot. People, no longer want their vacation home, or their Airbnb. They're tired of doing Airbnb. And so they want to sell it, but they still want exposure in real estate and they don't want to do any sort of management. So yeah, that can be an excellent strategy. But yeah, the depreciation recapture and the capital gains are huge components and should be considered when you're selling your property. I don't think people really realize the implications. And then if you're in a state like California, New York, or New Jersey, those are even you have a 14% of state income tax in California on top of all of those other tax implications. Um, so yeah, so there's definitely a lot to consider when selling your property and determine whether or not a 1031 exchange is right for you.
Yeah, now, of course, you can buy DSTs anytime you want. They don't have to go along with a real estate sale at a 1031 exchange. Right, Jennifer? I mean, I think we're seeing that a lot. Just people generally thinking, I need a vehicle that's going to provide passive income. DST is going to work, and then it's got all the other benefits as well. So it doesn't require a real estate sale to invest.
Yeah.
But when you're selling real estate, it's very important to remember that it's got to start with the 1031 exchange. And your qualified intermediary has to be in place prior to the closing of your sale. So it's not a DIY kind of thing. If you're a real estate investor and you're thinking, gosh, this sounds kind of intriguing, I want to explore it, you first have to involve someone like us to manage your 1031 exchange. That's all we're going to do. Then you're going to start your search, whether it's for new real estate or calling Jennifer to say, tell me more about this DST thing because I've listed my property. We're starting the process of the 1031 and we want to get involved. I get calls every month, Jennifer. It's so sad. People say, I closed on my property last week. I'm ready to do a 1031. Unfortunately, if you've waited that long without involving the QI, you're not going to be able to do it. So you're going to pay the tax.
Right.
So all of these are going to work best. All of these strategies are going to work best with advanced planning.
100%. The IRS is very strict about real estate investors touching any of the proceeds. If you're interested in doing a 1031 exchange, they're very strict about you touching those proceeds after the sale of the property, which is why they need to be with the qualified intermediary like Dave. And everything is done by the book, because you want to make sure you plan enough in advance so that you have the expertise of your qualified intermediary like Dave, um, guiding you through the process so that when your property does close, that money goes into where it needs to be, which is what with an intermediary like Dave, so that he can hold the proceeds while you're identifying your property. But I get those calls too. And, because we can get individuals into a DST so quickly, I get calls on, let's say, the 45th day of they are in a 1031 exchange, but they call me on the 45th day saying, their first choice has fallen through. Either they weren't able to get financing or the seller pulled out for whatever reason. And we're usually able to help them with that situation. When somebody completely misses a 1031 exchange, I get those calls as well, which is it's really unfortunate. Um, we do have some options where we can help with that situation as well. But, it's always just really difficult to see when somebody's so disappointed because they feel like they've missed that 1031 exchange boat. So definitely plan in advance, and make sure that you have a qualified intermediary. What I mean by qualified is somebody who has experience and knows what they're doing with 1031 exchanges.
Yeah, interestingly enough, and this again, this falls under the category of you can't make this stuff up. The IRS defines qualified intermediary simply as someone who is not disqualified. And the
Okay.
only thing that disqualifies you is if you have a family or business relationship with the client. So I appreciate that shout out about taking it one step further. Don't just look for the title, qualified intermediary. Find someone with some experience because we're generally the people that have seen enough, and we've got folks like you who we know are going to take care of the clients. So when it's that 45th day, we know that we can send our client to Jennifer and you've got something for them. Sometimes you don't have days to waste, and
Yeah,
that's when it's really important.
right. Yeah, it really is like you're on a timeline, very strict timeline. So, we do have a question. Do you want to read the question?
I
I
Let's see if
can
I can see it.
Here, I have it pulled up. Would a DST be an option for someone to invest in who is just starting out in real estate? For someone who might have some cash saved up and wants to start in real estate investing, especially with commercial real estate. Basically, start investing, not starting with the 1031 exchange. Okay, well, we touched upon that briefly. So what I always tell people is yes, the answer to that is you do not need to be in a 1031 exchange to invest in a DST. You are typically, and there are some, with all of it, I'm just giving you average numbers here, but average number, you're looking at 4 to 6% distribution on DSTs. Um, when you do a 1031 exchange, and the reason why it partners so well with a 1031 exchange is because you can really supercharge that amount when you are deferring capital gains tax. And I like using really big examples. I mean, this is not every client, but we did a $50 million exchange. The individual was deferring $12 million in capital gains tax. Think about being able to take that $12 million and put it into and really leveraging. And I think that's really the power of a 1031 exchange is that you're able to leverage that $12 million into another property. So DSTs go hand in hand so well with 1031 exchanges is because you're able to take that capital gains, leverage it into a bigger property. And the reason why the IRS allows you to do that is because that portion is going to help you purchase a larger property. Typically, you're looking at more cash flow. You're also looking at that real estate investor is going to need more supplies to manage that property. They're going to need a larger staff. They're going to need plumbers. They're going to need contractors. So it really helps the economy on both a macro and micro level. And that's one of the reasons why the IRS allows you to defer your capital gains like that. So going back to your question, you can do a DST on its own with the 4 to 6% return and the appreciation on the back end and any tax and incentives that you receive and deductions that you receive along the way. But without the 1031 exchange, you don't have the tax deferral strategy. And that's why we really like them to go hand in hand.
Yeah, I think for my view on this, Starting out, it's all really going to depend on what your return requirements are. And you've got to get very, very realistic with yourself and say, what is it? What are my real goals here? This person mentioned they want to get into commercial real estate. That's their ultimate goal. Well, getting into commercial real estate, number one, is typically a bigger ticket. So you've got to have more down payment, more money to get into it. How are you going to get that? Starting out with the DST, if you can pass the accredited part or the sophisticated investor part, depending on what level it is, then certainly, like Jennifer said, you're going to be making not a, I'm not going to say great, you're not going to be making as large a return, cash flow, as you might with some other real estate investments. But does that make it a bad investment? No, because it's all about what your tolerances are. Maybe you have a job that you love, and your goal is to leave your freedom to practice your job. Well, in that case, a DST could work out perfectly, while it's at the same time starting to grow so that ultimately you can end up maybe back in commercial real estate, buying triple net assets. Because just like you can 1031 into a DST, when the DST sells, you can 1031 back out. And maybe you've started two or three DSTs. They all happen to sell at in a close period of time. That gives you the chance to then leverage in and buy that commercial real estate. I wouldn't discount it simply because of the return that you're getting on cash flow. Because, like Jennifer alluded to, there's also going to be the other prongs of the internal rate of return. You're going to get your share of the appreciation. You're going to get the tax write offs while you own it. It's not just that you're deferring any depreciation, you get to continue the depreciation. So you're getting additional tax benefits as you go. And then lastly, if there's an amortizing loan on that real estate that's being paid off, you're getting your share of that, just like you would if you owned a piece of real estate. So I don't really view DSTs as a good or bad investment. You've got to really look at them and say, what's my goal? Can I become successful making 6% on this if it meets my other goals and needs? And that's what I love about it. It's the flex. Well, that's what I love about real estate investing in general, is the flexibility, the ability you've got to move into any type, any sector. DSTs are simply further along on the spectrum of passive versus active. And that can be really good for people retiring, but also might be good for people who are just starting out, but love what they're doing for their job. So I don't know if that makes sense. Um,
Yeah, yeah, yeah. Yeah, exactly. I mean, I think that you summed it up perfectly. It really depends on what your goals are as a real estate investor and whether that 4 to 6% is going to achieve those goals. There are some benefits, like you stated. You receive all of the tax, write-offs and benefits, the appreciation on the back end. You are investing with institutional quality investment firms. So a lot of these investment firms, your financial advisor may already be investing in your 401k, for instance, so, or your Roth or whatever. So these are, institutional grade properties with, a lot of these are multi-billion-dollar investment firms, which a lot of people tend to feel more comfortable with. These more well-known investment firms like JLL, Brookfield, Hines. It's not a mom and pop operator. So there are some benefits to investing in a DST without a 1031 exchange, but you have to weigh the pluses and the minuses. Yeah,
well said.
yeah. So, yeah, and a lot of people just start with a small amount. We do have that where they say, we're just going to put a small amount into a DST without doing a 1031 exchange. We've never done a DST before. We just want to see how it works and how it works for us. And then when they start to sell their investment property, they'll do a 1031 exchange into a DST with a larger sum of money. So we do see that.
Yeah, 50 to 100K minimums are what I'm seeing. Is that all right? Yeah.
Yeah. Yeah, exactly. So very low compared, people are usually very surprised that the minimum investment is 50 to 100,000. They expect it to be very much higher. So yeah, yeah, yeah. So yeah, did we cover everything? I don't see any other questions. Is there anything else we should talk about with the DST?
I think we just need to let people know where to get a hold of us so they can start their advanced planning.
Yes. Okay, I'll start. You can always find me on LinkedIn, which is Jennifer, Jennifer Sotelo, Sotelo. My email is jsotelo@cabinsecurities.com, CABIN securities, securities.com. I think I spelled that correctly. And then I think that should be sufficient.
Yeah, for us, again, remember, it's got to start well before you close the sale of your property. But you can come visit us at the1031investor.com.
Awesome. Well, thank you so much for having me, Dave. This was a ton of fun. I always have fun with you on these. And hopefully you and I will have the opportunity to work together on some 1031 exchanges and DSTs.
Absolutely. And I thought you were having me. We
Oh,
co-hosted.
it was teamwork.
Collaborative effort. There we go.
Yeah, it was collaboration. So
That's good. Great to see everybody who came in today. And do give us a shout, and we'll see what we can do to help you.
awesome. All right, Dave. Have a great trip.
Take care.
All right.